China's latest trade data for October 2025 presented a headline figure that, on the surface, seemed concerning. But, as is often the case, that number is just the beginning of the story. Beneath it lies a complex interplay of technical factors, profound structural shifts, and a critical geopolitical turning point. In this analysis, we're going to dissect this data to understand what it truly signals for the economic outlook.
So, let's begin with the conclusion. Our analysis points to 4 core takeaways. First, the headline export decline is more of a statistical distortion than a reflection of underlying weakness. Second, we're observing a clear acceleration in China's industrial upgrade, with high-tech sectors firmly in the lead. Third, October marked a pivotal moment in trade policy friction. And finally, the import side of the data confirms that the recovery in domestic demand remains fragile. We've structured our breakdown into 4 sections. We'll start by deconstructing that negative headline figure. Then, we'll examine the stark divergence within China's export mix. From there, we'll analyze the geopolitical developments that defined the month. And we'll conclude by assessing the key headwinds on the horizon. All right, let's tackle that headline number first. To really understand the October data, we have to peel back the layers of technical noise that are skewing the year-over-year comparison. Here it is, a 1.1% year-over-year decline in exports when measured in U.S. dollars. Now, this was a sharp reversal from September's growth and came in significantly below market expectations. However, viewing this figure in isolation is highly misleading. 2 primary factors are at play here. First, a high base effect. You have to remember that October of 2024 saw a 12.6% surge in exports, largely due to a rebound after typhoon-related disruptions. That creates a very challenging basis for comparison. Second, we saw a significant demand pull forward in September, where strong growth was inflated by companies rushing shipments to get ahead of potential tariffs. In effect, they borrowed volume from October. So if we smooth out these monthly volatilities by looking at the 2-year compound annual growth rate, a much clearer picture emerges. What this shows is that the underlying trend is not only stable, but it actually ticked up slightly from 5.3% to 5.5%. This indicates that the fundamental export momentum remains intact. Now, this is where the story gets really interesting, because beneath that stable top-line trend, a powerful structural divergence is accelerating. We are essentially witnessing a tale of 2 different export economies. This chart illustrates that divergence quite starkly. In October, automobile exports surged by 34%, and integrated circuits were up almost 27%. At the exact same time, traditional labor-intensive goods contracted by nearly 15%. This isn't a small gap. It's a structural chasm that highlights a fundamental reshaping of China's export drivers. And this is no one-month anomaly. The cumulative data for the first 10 months of the year confirms this is a durable long-term trend. You can see year-to-date growth for integrated circuits is up nearly 25%, and automobiles are up over 14%. Meanwhile, traditional sectors like labor-intensive goods and data processing equipment are in negative territory for the year, showing a sustained decline in their contribution. Now, let's introduce the third critical variable, the geopolitical landscape. October was not just another month on the calendar. It was a pivotal period for trade policy, and it's impossible to interpret the data without this context. The year-to-date performance by trade partners sets the stage. We see continued robust growth with ASEAN and Belt and Road nations, and moderate growth with the EU. But the key figure here is the nearly 16% year-to-date contraction in trade with the United States. This formed the crucial backdrop for the events that unfolded in October. This timeline captures the arc of events. Following a sharp escalation of friction in the 3rd quarter, tensions reached a maximum point in early October. The effective U.S. tariff rate hit a peak of 17.9%, and China responded with new export controls. Then, on October 30th, a significant agreement was announced, marking a clear de-escalation in tensions. And the consensus view is that this late October agreement represents a major turning point. It has fundamentally altered the macroeconomic risk environment. Therefore, the October trade data must be viewed through this lens, as a snapshot taken at the moment of peak friction just before this pivotal policy shift. So, given this new landscape, what should we be watching for? In our final section, we'll outline the key risks and factors that will shape the trade outlook from this point forward. We see 4 primary headwinds to monitor.
First, and most importantly, is geopolitical execution risk. The durability of the new trade agreement is the primary uncertainty. Second is the risk of a broader global demand contraction as economic outlooks in the US and Europe soften. Third is RMB exchange rate volatility. Any rapid appreciation could impact exporter margins. And finally, the long-term, structural trend of supply chain diversification or de-risking, which continues in the background.
To summarize, the October data reveals an economy at a critical crossroads. The statistical noise is fading, a new policy framework is in place, and a powerful structural shift is undeniable. This leaves us with the defining question for the quarters ahead. Can the powerful growth momentum in China's emerging high-tech sectors prove strong enough to offset the persistent headwinds from a slowing global economy? That will be the key dynamic to watch.